Hey, good morning, everybody. It's Hammer. Today is Monday, June 23rd, 2025. I, of course, am your man here with your daily mortgage rate update, the only place on the web where you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, where we talk about what's going on with the mortgage rate market. Broadcasted to you on Facebook and YouTube. I think later this week we will add Instagram to that as well. I'll be working on that. So anyway, if you're here this morning, say good morning. If you're watching on the replay, don't forget, give me a hashtag replay in the comments. Let me know that you were here. Don't forget to smash that like button, tag an LO friend, share this post in the group. If you're on YouTube, subscribe and give us the thumbs up. Remember, the more you interact, the better that it is for me. Not only do I want to hear from you, but it also helps us with the algorithm. So appreciate you doing that. If you would like a quick reminder that I'm going live, I do send out a text message each morning as I go live, and you can sign up for the reminder at hmmr.io/reminder. That's the Hammer Solutions short code, hmmr.io/reminder. And you could use this cool QR code over here. And if you are on your phone, take a screenshot. You can come back through your pictures and use that QR code, and it will work as well. Also, while you're out and about, don't forget to go check out Grab and Go Social and Originator Success at originatorssuccess.com, grabandgosocial.com. Check out those wonderful products that we make that are under my umbrella here. So anyway, let's say hi to the live folks here this morning, and we'll go ahead and get started. What we're going to cover today, we're going to talk about minimal market reaction to bombing Iran, why the Strait of Hormuz is important to mortgage rates this week, and how things could play out for rates going forward. So good morning, Deb Dickinson, Rob Smith, Brandy Brickler, Sean Segaloff. Thank you for tagging a friend. Appreciate you, sir. Angela Walters, good morning. Mike Brown, great to have you here as well. So remember, if y'all are here as you're rolling in, say good morning. Otherwise, we're going to go ahead and get started. We'll jump right in, and let me go ahead and share the screen. We'll show you what's going on this morning. So this morning, mortgage bonds are actually up on the day. You can see here we're up about 11 basis points on the day. Let me bring up Presentify here. Let's see. Presentify. There we go. All right. So you can see here that we are up 11 basis points on the day, and that is wonderful. Friday, we saw bonds improve. So pricing comes out around 10 a.m. That's right about here. You can see that this is higher. Higher is good. So we did see bonds improve through the day. They ended the day over here. So again, that is higher on the day. There were a handful of lenders that did reprice better, not a crazy amount, but certainly, enough to be happy about it. So we did see some improved pricing. This morning, rate sheets will be improved, though. You'll definitely see some improvement this morning. Go ahead and share the screen again. Good morning, Ron Siegel, Michael Love. Great to have you guys here as well. So anyway, going over here, you'll take a look. Rate sheets this morning should be better. We've seen some nominal improvement. If you take a look here, we were as high as 691. No, not now. I'm clicking the wrong things here. Here we go. Okay, so we were as high at 691 here, and we ended at 686. This morning will be a little bit better than that. Again, some of the better pricing that we've seen in the last month. The previous was, let's see, we had 6.89, 6.87. So 6.87. We had 6.86 a little bit before that, but so we're seeing some of that best pricing. Overall, though, you could see there hasn't really been much movement when it comes to rates and pricing. It's very consistent. We're seeing changes to rate sheets, to pricing, but not really to rates themselves. Rates have really been staying still. So this morning we're up, like I said, we're up 12 basis points on the morning. 10-year treasury yield is lower, 4.34. Let's zoom in on this. I may have to refresh it. Here we go. So taking a look here, the 10-year treasury yield, 4.34. It ended at 4.37. So we were up as high to start the day here. Remember, yield is reverse of bond pricing. When we look at this chart over on this side, we want to see pricing go up. Up is better for rate sheets and better for pricing. When we are looking at the 10-year treasury yield over here, though, we want to see that go down. Down is better. Lower yield is better. So I had said in our text alerts that basically the black swan event that could happen over the weekend that could help us would be if we did bomb Iran or attack Iran or get involved in the conflict. We did end up bombing Iran. I'm not going to go too deep in the conversation here. I noticed that people's political affiliation has a large part to do with their belief on whether that was the right move or the wrong move, but it doesn't matter. It was the move. It's what happened. So we did not see a huge flight to safety. And let's kind of talk about that a little bit, though. So, real quick, I'll just finish the rest of these and then we'll get to that. So, reprice risk on the day is low. It's not likely that we see bonds get in a position that we have to really worry about lenders repricing worse. We're actually in a really good spot when it comes to rate sheets and where things are at there. So, not really any concern about that. The outlook remains, we're not likely to see rates really improve that much this week, but we are likely to see pricing improve. And if you take a look here, again, this is mortgage bonds, so we want these to move higher. And this is kind of we're back up at some of the high point. Now we were here. All right, look at this. We were right up at the same level, and then boom, fell back down. We're right up at that same level, and we are testing some technical. Actually, let me switch this to the little line here. To the arrow, and that'll give us, we are actually testing right about, oh, no, that's the wrong spot. Here we go. Okay. Right about there. So we are testing that technical support level, which right here is fantastical. I have a feeling that we are going to break through and that we will move higher. Now, as far as technicals go, we could say about the red, the 50-day moving average, the green 100-day moving average. Those will act as support levels. If we were to move down, it could technically bounce up. Same thing happening here. We could hit that and bounce up, which is what happened here on Friday. Friday, we did test that 100-day moving average. I'm sorry, 50-day moving average, and we did bounce up. Now, that was just with normal trading. So that's kind of where we're at as far as all of this stuff goes. Expectations for now that we have gotten involved with Iran, that what that's changed hasn't changed anything on the Fed side. If we take a look here, basically we were at 85% expectation that we could see a cut at the next meeting a week ago. I'm sorry, 85% that we would not see a cut, 85% that we would not see a cut a day ago. And this morning is at 83%. So really no change there. September, it has gotten a little bit more that we would see a cut in September. So a week ago was 55. Yesterday it was 60. Today it's at 59. So by the end of the year, expectations, you could see that it's almost flat. We really haven't seen much change as far as expectations that we would have 2 rate cuts for the year. That's what markets are still pricing in the basically overall is what we are expecting to see. So let's hit some of these articles. This is the key, right? 6 miles of water keeping global markets on edge. That is called the Strait of Hormuz, which sounds like breakfast sausage, right? Like Hormel. Iran is threatened to close the Strait of Hormuz, rattling oil markets. All right, again, opinions are like buttholes. Everyone has one and they all stink. Here's mine. There's no way that Iran is going to mess with the Strait of Hormuz because Iran is a tremendous underdog in this whole thing anyway. We're not going to talk about their regime or the people that are there or anything else. We're just talking about the decision making from the entities in power in Iran. Money is needed to keep all of this stuff there. If Iran is going to buy munitions, they're not manufacturing munitions. They're not manufacturing missiles. They're going to be buying them from China or Russia, probably more Russia than China. And right now, we don't know if that's happening. It probably is, right? That takes money. So where does Iran? Iran produces 30% of the oil that goes out every day in the global oil market. So if they were to do something to the Strait of Hormuz, it's basically a self-destruct button. If they shut down their flow of money, they would absolutely shrivel up and die. So the reason we're talking about this is that if oil prices were to go dramatically higher. Right now, oil prices are up. I think that was at 77 a barrel for crude, Brent crude, earlier this morning, if I remember correctly. Oil prices did have a bit of a reaction higher when we bombed Iran. That was the initial reaction. Now, did we see a flight to safety? You could argue. We were at 4.38. Now we're at 4.34, 4.35. So it's a nominal move. Overall, markets really not putting a lot of emphasis. They don't feel like this is going to be a long, protracted. I don't want to say war, because a war is a very conflict, we're going to call it, right? So they don't feel that the U.S. is going to be involved in a long, protracted situation there. Also, a concern is oil prices. So you're not seeing a huge flight to safety here. Now, what's funny, though, is there was an argument that you saw global bonds fall, meaning that yields would go up, that there would be a flight to safety as Mideast tensions keep inflation woes alive. So that's part of the concern. U.S. Treasuries fell slightly due to escalating Middle East conflict, stoking fears of oil supply and disruption and inflation. Treasury yields ticked higher. Well, they're not higher, they're lower. With 10 years up to 4.4 as traders paired bets on interest rate cuts from the Federal Reserve. And again, this article was June 23rd, which is this morning. And yet they're telling that they're higher, but I don't know. I see 4.37 and I see 4.35. So they're not higher. This article is, kind of pulling whatever. So fear of potential supply disruption driving up inflation is the same argument that we had before. That is the concern, is that if oil prices were to go up, it's going to push up inflation. Probably not going to happen. So, and let's see, what is Siegel? What are you sharing us? With softening inflation picture, a deteriorating labor market, what would cause Powell to lower rates? Nothing short of recession. His term cannot end too soon. His legacy is that of a partisan hack. You and I will agree to disagree here, my friend, as you know. It's how deteriorating is the labor market. And we've been through this before where, the labor market was supposedly softening and unemployment was shooting up, and then they came through. They have room to cut rates if they need it. But I think with all these different things going on, it's perfectly fine. And at the end of the day, although the housing market is certainly hurting, I would argue that it's not interest rates that are hurting the housing market, it's housing prices. My own home, I bought it in 2017. I spent $415,000. It's worth double that today. Double. That's not normal. That's not acceptable, especially when almost all of that came after 2021. So that was what caused the problem that we're in, not rates. It's prices. And I think we will see a correction, especially in some markets, but I don't think we see a crash. The reality is prices will come down as people want to start selling houses. It's supply and demand. When inventory goes up, rates don't have to move at all. Inventory will go up and house prices will start to come down a little bit. And that's what should happen for a while. It's the ebbs and the flows of the markets, and it needs to happen. It's not what people that want to move out of their houses want to hear. But anybody that's sticking around in their house, it's just like any time in the last 10, 12 years, we're going to see things increase and continue to increase. My house will be worth more in 2030 than it is in 2025. So will yours. Keep that in mind. But Iran vowed retaliation. I'm going to be careful here not to get too whatever, but so what? The reason that all this is happening is because they don't have the munitions for long-range intercontinental ballistic missiles. They don't have, just like North Korea, they don't have the ability to reach us yet, and just trying to make sure that they can't. That's kind of the bottom line. And, it's funny because everyone talks about doing this with diplomacy, and we did have diplomacy, and yet they still managed to do more. As far as now, the UN can't go in and check their stuff. Guys, the technology that we have, we've got the ability to do LiDAR and check. They're 120 feet under the ground for these things. We can see 120 feet into the ground with satellites. It's crazy, the technology that we have, and probably what we don't know that we have. So who cares if we can't go there? They were lying to the world anyway. So we'll see. Ron said the housing market has a major impact on the economy. I agree, but I think more of an impact on the economy is the credit bubble. I think consumer credit is the bigger driver right now. And when that starts to slow down, I think that's going to be what's going to cause the biggest concern is the credit crisis. So Dave said ridiculously low rates created a huge artificial demand that caused your home to double. Yes, right. Absolutely. Not saying they didn't. I'm saying that rates don't need to be lower now. Home prices need to be lower is what needs to happen. We need some return to normalcy. We need to fix some of the damage that was caused by what you're alluding to for sure. Sean said inventory has a major effect on the housing market. More people born, longer living, and so much land to build. Well, there's plenty of land to build, but regulation is the thing. Combined with the STR boom of mom and pop investors. Yeah. So Dave, we don't need to go to ridiculous low rates. We need to get rid of the restrictive rates. Yeah. So, all right, y'all. Well, 16 and a half minutes in. I'm going to wrap it up. Again, just to reiterate where we're at, I probably should have thrown this on the screen a little bit earlier. My advice is to go ahead and cautiously float. So generally, I don't think we have to worry about rates moving up this week. If Iran were to close the Strait of Hormuz or do something there, that would be a big deal. It would definitely cause concern and shakeups in markets, but I don't think that that's likely, and either does anyone else. Oil traders see it as a worst case scenario. Pentagon officials have long warned against it. Vice President J.D. Vance believes it would be suicidal. Yet Iranian lawmakers on Sunday, they rattle their little sabers. I mean, they're not closing anything. So anyway, I don't want to go too far. Dave said this has been a tougher market than even during the Great Recession. Yeah, and Dave, and especially that's regional, man. Like it's all inventory controlled through most of this. So there's some areas and some people that are doing amazing, but in some markets it's very, very difficult. I absolutely agree. So, but this week, I don't think we have to worry about rates really getting too much better this week, and I don't think we have to worry about them getting too much worse this week. We're going to watch this 10-year Treasury yield. We want to see if it does drop down. See how right now it has broken down below. And again, yield going down is what we want to see. It's broken below this green line. That is the 100-day moving average. So right now that is at 4.37. So we're going to watch the 10-year Treasury yield in that 4.37 mark. We're going to see if it gets down and tests that 200-day moving average. Even when we did test it in the past, we had a couple of days and then it was back above. Over here, it was a longer stretch, a little over a week, and then it broke back above. So we would be watching, but there's definitely room to see this move. There's room for everything to improve is the bottom line. We can see that happening here. We can also see it happening here for mortgage-backed securities. The 100-day moving average, this green line, will act as a support level. Again, we were up above it. Next day, we fell below it. We were up above it. Next day, we fell below it. Today, we are back up above it. What does tomorrow bring? Do we fall back below? Is it third time? Or is this the time where we actually continue to increase and then test this 200-day moving average as it works its way down? So that's what we'll be watching to see and go on. So, all right, my friends. Well, that's what we got. I hope you all had a fantastic weekend. What did you guys do this weekend? I did some motorcycle maintenance, changed out the sneakers or the tires on my motorcycle, changed out all the brake fluid and hydraulic clutch fluid because they are hydroscopic and they absorb water, so you got to change it out every couple of years. So I was changing that and then went for a nice dinner ride last night with the missus. We had a fantastic time. What did y'all do this weekend? And what you got going on? Anyone having any fun travel plans? Anyone taking any vacations? Let me know in the comments. Otherwise, we'll be back tomorrow. We'll talk about what's going on, and I'll see you then. Take care, everybody. Make it a great day. Bye-bye.